Thank you for watching. Today we're going to talk about bonds versus bond funds, which are best for your portfolio. And bonds can be a confusing subject, and so we're going to help simplify that subject here. If you've been thinking about allocating some of your portfolio to bonds, we're going to talk about the differences between bonds and bond mutual funds. So I want to thank you for watching us. My name's Richard here. We're at Wisdom Investor. What we do here is we provide valuable information to help you accumulate a nest egg for retirement, build your financial wealth. So the first thing is here, what exactly is a bond? Okay, a bond is basically it's debt, it's a loan, it's an IOU. It's just like you go to buy a house, you get a loan. You go in debt to buy that house, you owe money, and you're going to pay it back. Okay, you also pay it back with interest. And it's the same way with the government. They go in debt to fund various projects, maybe road expansion. It could be the military. It's money that you don't have. And then you take this loan, and then other people or countries can buy your debt. And in return, they're going to get paid an interest. Okay, so companies go into debt for expansion. Maybe they want to develop more offices, so they may borrow $10 million and go into expansion with multiple offices. So they don't have that money, and so they set up a bond, and then you, as an investor, can lend them money, or buy a bond, and they're going to pay you back a certain percent. And then after a certain period of time, you get your money back. A school district may do a bond for school expansion. So they go in debt, and then they say those who buy our bonds will pay them a certain interest. So basically, you're lending money. When you buy a bond, you're lending money to the government so that they can use it, and then in return, they're going to pay you an interest, and then after that term is over, you're going to get your money back. So that's the simplicity to a bond. It's debt, and that's all it is. So we're going to talk here about individual bonds and also bond mutual funds. So individual bonds, typically when you go to buy an individual bond, it's typically around $25,000. And that can vary, but typically you'll buy a bond is about $25,000. So a certain type of investor is going to be more apt to want to invest in bonds. And so as we said earlier, it's going to pay you a certain percentage. Let's say you get a 20-year bond at 4%, and let's say it's a $25,000 bond. So every 6 months, you're going to get paid a certain amount. You're going to get paid 4% every 6 months. And then we said it's a 20-year. It has a term. So if you just left your $25,000 in there over that 20 years, it's going to mature and you're going to get your money back. Okay, that's how basically an individual bond works. Now, typically for diversification, you need to have about $250,000 to $300,000 to get adequate diversification. So again, this needs to be somebody who has a pretty good size portfolio so that they can invest in bonds and maybe other things too. A couple of things to always think about with the bonds is credit risk. If it's a school district, the credit risk on that is probably pretty slim. They're going to be able to pay it back. Now, if it's a company and they are having a hard time and they need money to expand, they may have to pay a higher interest rate and the credit risk would be lowered. So what that means is before you buy an individual bond, you're going to have to do some research on this bond. And you also have to monitor the bond over its lifetime just to make sure there's no problems with credit risk. And then we have bond mutual funds. A mutual fund company will invest in various bonds, and they will allows you to pool your money together with other folks, and you're able to buy into a bond mutual fund without having to spend $200,000 or $300,000 to diversify yourself. So it's a pool of money, other investors all pool together to buy typically maybe 50 to 100 bonds in one bond mutual fund. Now the key to a bond mutual fund versus an individual bond is there's professional management. In a case with the individual bond, as we just talked about, you have to manage that yourself. You've got to pick out the fund, make the decision, buy it all yourself, and you may be working through a brokerage also. And now an advantage here to the bond mutual fund is it does give you some diversification. You're diversifying in various different bonds, and so your risk is broken out over those 50 to 100 bonds. To get involved in a bond fund, typically it can be $1,000 to $3,000, some of them maybe $5,000. So just about anybody can get involved in diversification. You don't have to go out and spend $250,000, $300,000 to get diversified. And when you invest into a bond, they're going to pay you a certain percentage based on the interest rates. And if you sell it, it's going to depend on what the net asset value. Now, bond mutual funds can vary somewhat depending on the interest rates. As interest rates go up, the net asset value may go down. So as the interest rates go up, you may get more on a regular basis on the percentage that you're paid, and the net asset value will go down. So that is the differences between a bond, individual bond versus bond mutual fund. Individual bond, you're typically going to buy, say, like 20-year bond. It pays 4%, and it's $25,000 at the end of the 20 years. You're going to get your money back. You could sell an individual bond before it matures, and the price, and in that case, will depend on the value of the bond as you sell it. Okay, we're going to take a look at some different bonds and see how they're constructed and just get an idea a little bit more about the net asset value, how it can change and fluctuate. Okay, we're taking a look at the TLT bond fund. This is a 20-year bond fund, and you can see here as the price on this is fluctuating. So let's compare it to interest rates. Here's a 10-year treasury here, and this is over the past year. The rates have moved higher, and then they moved lower. So let's compare that to the TLT bond fund. As the interest rates moved lower, the bond fund moved higher. So that gives you a little bit of a example here of how bonds can move with interest rate. Back here, the bond itself, the 20-year bond price was moving lower, and if we look at the interest rate was moving higher. So that's just some basics to understand. So let's take a look at some different bonds here. And this first one is DLSNX. This is a short-term, low-duration bond fund, and it pays an interest of 3.4%. And this is a bond mutual fund that you would purchase. So let's look at a breakdown on this bond mutual fund. This is some information from Morningstar. So this DLSNX SX says here minimum investment is $2,000 and 30-day yield 3.49%. And let's just take a look at, this is a short-term bond fund. So a short-term fund is going to have less interest rate risk. If you'll notice here, you do not have the price fluctuation like we looked at the TLT, because the interest rates are very short term, so there's not a lot of fluctuation. So this would be a good bond in a rising rate situation. Remember, as we said, rates go up, bonds go down. So this one here, top holdings, you can see is U.S. Treasury notes. pretty much pretty safe, pretty secure investment. Top sectors, U.S. Treasury, government-related bonds here. And then if you also notice up here, we talked about management. There's the managers here. They've been there since 2011, one new one since 2016. So that's the DSLNX bond fund. The next one to look at is Double Line Total Return Bond Fund. Now these are just sample bonds. There's many different bond mutual funds out there. I'm using these as example. Now you'll see this one, it's a little bit longer duration on it. You can see a little more fluctuation in the price. Let's take a look at DLTNX and just see the internals on this one. Again, minimum investment $2,000. It 30-day yields 3.56%, and it has management here, 2 managers here, and top holdings are some treasury notes here, Loan Mortgage Corporation. Top sectors are various agencies here and a little bit of a commercial. So this is an example of the little more longer term bond fund. Here is the Osterweiss Strategic Income Fund. Now this one is more into corporate bonds. It invests in corporate bonds. Now we talked about you can have government bonds, you could have corporate bonds, and you could have school districts, and etc. So this one specializes in corporate bonds. So it's a mutual fund. And let's take a look at the internals on this particular fund. The minimum investment is $5,000. Doesn't show the 30-day yield on it, but it's, let's see what we have over here. It was 3.66%. And it's has its managers, been there since 2002, 2013, 2017. Top holdings here is a mining corporation, resource aviation capital, a logistics company. So they invest in bonds from various companies. Let's look at the sectors. Corporate bond is 74.2. You can see that's their main area that they invest in. So to just kind of give you an idea, if a person is doing some income investing, this is a sample portfolio. 20% Vanguard Wellesley Income Fund, 30% Double Line Total Return Bond Fund, 20% Low Duration Bond Fund, 20% Vanguard Money Market Fund, and 10% in the Osterweiss Strategic Income Fund. This is a sample example of a portfolio or asset allocation. So we've talked about the individual bond funds here. This is going to be more for your high-end investor who has more capital to work with. We've talked about the bond mutual funds that are more diversified and easy to get involved with for the average investor. So I want to thank you for watching and through this simplification of understanding bonds versus bond mutual funds. I want to thank you for watching.